Hello and welcome to Market Domination Overtime. Stocks closing mixed here as AI worries fuel a tech sell-off. Jared Blickery over at the Wi-Fi Interactive with today's moves. Jared.
Thank you, Josh. Yes, a mixed market. We'll start with the Dow, which closed in the green for 0.5% or 259 points. And let's take a look at the intraday price action. Mostly green right there, brief spell in the red. But the NASDAQ was red the entire day, down 1.5%. We're going to take a look inside the tech trade in a minute. And the S&P 500 down about 0.5%, was trying to climb back to unchanged, but couldn't quite make it. But the S&P 500 equal weighted index not only closed green, up short of 1%, but also at a record high. And I've noticed that when the Dow is up, so S&P 500 equal weight tends to be up as well. Now, small caps, it's a different story depending on which metric or market you're looking at. Russell 2000 in the red for 0.7%, but the S&P 600, which only allows in profitable companies, that was positive the whole day, just about, and that was up about 0.9%. Also positive, S&P 400, that would be the mid caps, and I went over this before an hour ago. The micro caps finishing in the red, down almost 2%. Well, I do want to talk about the Dow Jones Transports. We'll take a look inside there in a second, but this is the third day that they have surged over 2% each day. And you take a look at that total up almost 8%. That is pretty unusual. I haven't seen that since May of 2025. Excuse me. So let's take a look at some of the sector leaders, materials, and I'm going to point out energy, staples, and industrials. All of those closed at records today. Materials was in the lead. That's where you see the gold and silver trade. That was up over 2%, followed by energy. That was also up 2%. But to the downside, the three biggest losers were the mega cap sectors, and by far and beyond, 2.82% down for tech. And let's take a look at what that looked like inside the NASDAQ 100, where we're seeing quite a bit of dark red dotting the screen. We got Palantir and AMD down 11 and 17% respectively in the middle of your screen. NVIDIA in the upper left down 3, Meta down 3, Tesla and Broadcom down 3 to 4%, and the list goes on. I will point out that Apple is almost back up to record highs. Let me just show you the one-year chart there. And you can see it's getting closer. So Apple kind of leading the mega caps at this point, but it's not a great group in terms of broad leadership at all. Software did pretty well today. We are seeing some dark red spots from the likes of Oracle, Snow, Datadog, Take-Two, and Shopify. But we do see a different story in semiconductors. A lot of red on this screen. And this is actually the second day in a row where we've seen some problems there. Some of these are earnings stories. Take a look at AMD. That's down 17%. I was just looking at Ryan Dietrich's Twitter feed. He was pointing out that famous Time magazine cover featuring the AI leaders from last year. Well, Lisa Su was there front and center too. So all of these AI companies are just taking kind of a bath right now. And on that note, I'll send it back to you, Josh.
All right, thank you, Jared. Well, Alphabet fourth quarter earnings just crossing the wire here. Let's get you those results. Q4 operating income, $35.93 billion. The street was closer to $36.95 billion. Top line, $113.83 billion in revenue versus an estimate of $111.4 billion. I'm just looking for revenue ex-TAC. There it is, $97.23 billion. The street was at $95.17 billion. Ad revenue, that looks better than expected, $82.28 billion. The street was closer to $80.89 billion there. Looking for Google Cloud, there it is, where of course Google competes with Amazon and Microsoft. Google Cloud revenue, $17.66 billion. The estimate was actually $16.2 billion. And now for CapEx, they see 2026 CapEx. It looks like they're calling for between $175 to $185 billion. Per Bloomberg, the consensus on the street was more like closer to $120 billion. And that perhaps explains the reason we're seeing a quick move lower here in the after hours by about 6%. Remember, of course, expectations for this stock sky high heading into this print. I mean, this stock was up around 80% in just the past 6 months. Investors had decided this one was an AI winner. It was a remarkable change in the story for Google in that a year ago, if we were talking, all the talk was here comes Sam Altman, here comes OpenAI, and what that means in terms of Google search. Google hit right back with Gemini AI models with AI overviews, and investors piled in and rewarded them for that. But now we see a quick drawdown in the after hours, perhaps on that CapEx number. Again, they're calling for 2026 CapEx. Companies saying 175 to 185 billion. The street had modeled closer to about 120 billion. Well, joining me now is Ivanka Delevska, founder and CIO at Spear Invest, and Dan Flax, Neuberger Berman, senior research analyst. Welcome to you both. Ivanka, I'll start with you. The stock is at a quick roughly 5% in the after hours. What do you make of those results?
From what I heard, Josh, it's basically all about expectations. I think expectations were high going into the quarter, and you really had to exceed by a lot this quarter in order for the stocks to work. So the fact that they came in line to slightly lower in some metrics plus the higher CapEx, I think that's probably driving the stock. I think for us, search is an important data point. CapEx is important as it relates to the AI trade. We don't own Google, but we own a lot of the companies within the value chain. So I think the AI story is on track with those CapEx numbers that you just read.
Dan, I want to bring you in here as well. We're kind of yo-yoing here in the after hours. Looks like we're bouncing now down about 3%. Q4 revenue ex-TAC, Dan, that looks like a beat. I mean, 97.23 billion. Consensus was more like 95 billion. But that 2026 CapEx number, Dan, 175 to 185, when the street was closer to 119.5. Perhaps explain some of the pressure here, down about 2%. What do you make of it?
I think the results were strong overall. Clearly, there's focus on the CapEx numbers and, of course, the operating income. But I think the search business is healthy. And really, this company is continuing to reinvent itself, reinventing search with AI. Overview's AI mode. Clearly, there's a lot of momentum behind Gemini. And so I think the company is investing from a position of strength. We remain long-term owners of the stock, as you know, Josh. And what I see here is a company that really sees the opportunity to play offense. They have the balance sheet and the free cash flow generation to support the aggressive CapEx. And so we continue to like the name here.
You know, it's interesting, and now the stock is down about 1%. It's amazing, Dan, just the story, how it shifted here, the narrative it shifted. You know, if you were talking 12 months ago, Dan, you remember that. It was like the fear around this name, that OpenAI was coming. They were going to crush Google search, which, of course, listen, that's the company's bread and butter. A remarkable turnaround, Dan. I mean, heading into this print, the stock was up about 80% in the past 6 months. What do you make of that turnaround? What do you make of that narrative shift?
I think it's being driven by the innovation, by the execution on the product cycles, really taking search to a new place. They're delivering value to users on one side with longer and more complex queries, and that creates value for the user. And then on the other side, they're creating value for the advertisers. And so I think the technology risk, and of course, the market's very worried about disintermediation and disruption across the space. Google is demonstrating that even with fierce competition, they can navigate and, in fact, capitalize on the opportunities from generative AI. And so when I look out over the next several months, I think this push and pull will continue. But Google, in my view, is able and has the pieces from the silicon, the data, the models, the products, and, of course, the users to really seize this opportunity to drive strong growth.
You know, we battled right back to the flat line here now, Ivana. On this higher than expected 2026 CapEx forecast, Ivana, let's say you were on the call. What would you ask executives about that?
Well, the key is going to be where the investment's going into, whether it's in hardware, is it going to be building out their own TPUs? I think that's one interesting angle of this story. I think they're going to make some really good segue into that market. So the question is going to be, where is the CapEx going? We really like the infrastructure side of the AI trade. We see the most upside there. We think a lot of these big CapEx numbers are translating in really big numbers for the value chain. So that's really where we're focused on.
Dan, how about Google Cloud? Revenue 17.66 billion. That looks better than consensus. How do you see, what are the trends in that business, Dan, in the year ahead?
Josh, I think the Google Cloud opportunity is tremendous over the next few years. When we speak to customers, they get a lot of value from the Google offerings in areas like analytics is one example. And so this opportunity remains incredibly early. The company has been building it under Thomas Kurian and the leadership team. Its ramping margins have been improving in the last few years. And so I look at this opportunity and see a $100 billion revenue business over time. And I think the story here, when you take the cloud and you take YouTube and you take search, it's this broadening of the growth drivers. And I think the cloud opportunity provides a level of durability to the overall company, which is, I think, important from an investment perspective.
Ivan, a lot of investors pile into Google because they see this as a company with the full stack, meaning they got the chips, they got the cloud business Dan was just talking about, they got the massive distribution. Does Google almost sort of stand apart in that?
Absolutely. I think they're really out of the mega caps. They're probably the best positioned one because they have the long-term moat that's backing up a lot of their businesses. So I would say absolutely they stand out on the full stack between the chips and the fact that they can easily monetize them even for their own use cases. I think that sets them apart. And they're able to basically offer the services for free where everybody else has to offer ads and other stuff into their products.
Dan, I know you like the stock, but after the run it's had, my friend, again, monster run, 80% in 6 months, Dan. Do you like it just as much here, Dan? How do you think about valuation at this point?
What we're looking for is the free cash flow generation over the next few years and really the growth rate of that free cash flow. We discussed the cloud business as one example where they've built an extraordinary franchise, which is actually very, very early. And I expect that as an example to generate a lot of free cash over the next few years. And so when I put the pieces together, I see a business that is likely to compound at double-digit rates for Alphabet as a whole. I think there's a lot of potential in newer areas, longer term, for example, with Waymo. And so the valuation, in my view, remains attractive here with a 1 to 2 year outlook because I think there could be stronger growth than the market expects. And I also think the business mix is becoming stronger and more durable. And so the key is coming out of this period, Google, in my view, will be in even better shape than it is at the present day.
Ivana, Dan mentioned Waymo there. We should note, Bloomberg noting just raised $16 billion at a $126 billion valuation. You're a longtime tech investor. How broadly excited are you about that space, autonomous driving?
Well, I think it's a very exciting space, George. The question is that we're still in very early innings. So I think we're still 5 to 10 years out from where we can really have autonomous cars deployed everywhere. And this goes along the lines with the robotics opportunity. I think both of them are very strong long-term opportunities, but there is really, the use cases that we see today are not really there to justify the next 2 to 3 years of return. So I think the application layer will be very interesting long-term, but it's going to come a little later in this cycle.
All right, Alphabet stock continue to yo-yo here a bit in the after hours. All eyes now, of course, on that conference call. Dan, Ivana, thank you so much both for your time. Appreciate it. Turning now to Qualcomm's first quarter results. Yahoo Finance Dan Howley joining us with the latest numbers. Dan.
Yeah, Josh, not great in the outlook, but pretty good in the current quarter, the quarter that they reported, so the previous quarter. Shares are now down around 6.5%, a little bit more. For the prior quarter, they reported EPS of $3.50. That was better than the estimates of $3.41. Revenue of $12.3 billion, better than the estimate of $12.2 billion. The QCT, their Qualcomm CDMA technologies, that's their semiconductor arm. Revenue came in line there pretty much. Ditto for their Qualcomm technology licensing arm, that QTL. That came in at $1.5 billion, give or take a few million there. So in line, generally a decent quarter, but it's the outlook that has Wall Street kind of putting the brakes on them right now. Essentially, the outlook comes in for $10.2 to $11 billion for Q2. The original estimate was for 11.18, so just shy of that point that the street was looking for. And in their release, Qualcomm specifically points to some headwinds from the memory shortage in the smartphone market, but they still say that they're on track for their 2029 goals for revenue overall. And this all comes as the company is kind of transforming itself, right? They're very heavily dependent on the smartphone market right now still. They know that Apple is leaving over time. They're moving away from their modems to their own in-house chips. And so Qualcomm is in this mode of, okay, let's spread out. Let's find other markets that are better for us. That includes things like PC chips, which, I've used some of the computers that use their PC chips. They're very good, very capable. They're also getting into robotics. I got to see some of that in person, hands-on at CES when they had kind of shown off their new chip there. So this is all part of their strategy, but clearly this headwind from the memory shortage caused by the AI build out, not something that the street really wants to see.
Dan, a big question for Qualcomm investors is what you think smartphone growth is going to look like in 2026. Analysts will say, it's been okay, but what do you see ahead? Tailwinds and headwinds.
Yeah, I mean, look, for Qualcomm, it comes down to, the obviously the radio chips, the CDMA technologies that they're known for, and their own processors that go into into smartphones from the likes of, say, Samsung. Now, on the higher end of the market, you may not see as much of a slowdown just because if companies have to raise prices or even eat into their own margins, then that's going to be okay to deal with or easier to deal with on the high end. It's the lower end of the market where the margins are more compressed that they may see issues with sales. And so overall, I think they're looking at this and figuring, look, the memory crisis isn't going away anytime soon. We're going to have to just kind of gird ourselves for this and give everyone a heads up that there could be issues with smartphone sales going forward in 2026. Now, the flip side of that is Apple just reported a blowout quarter for the holiday, and they say that they're expecting some headwinds in Q2 from the memory crisis, and then that kind of snowballing more moving forward into the year. And so we don't really know what's going to go on, but everybody that I've talked to has said, look, this is going to impact smartphones going forward.
All right, Dan, thank you. Coming up, an up-down day on Wall Street, some ideas to position your portfolio. That's coming up next. Markets closing off the lows of the day, but tech stocks got crushed again. And my next guest is on the sidelines right now when it comes to equities. Joining me now is Adam Phillips, EP Wealth Advisors, Managing Director of Investments. Adam, it is good to see you. So big picture, Adam, you're neutral on equities and you're underweight U.S. versus international. Maybe start there. Help me just understand that, your positioning here, Adam.
Absolutely. Well, we've been overweight international for about a year now. And we still like that play. Last year we were talking about how there was kind of this peak U.S. exceptionalism. People were starting to wonder why you still own international in the first place. And we were talking about valuations being attractive overseas, and we just needed a catalyst. And last year we started to see it with more spending. We saw a lot of rate cuts from overseas central banks. And now, as we're starting to see this fragile state within the AI trade, we're looking at international, where in the S&P 500, you have 34% of the index is tied to technology. It's less than half that overseas. And so I think that's just one more catalyst in support of looking overseas. And so we are maintaining that overweight position.
I take your point, Adam, that the AI trade looking a bit more fragile here, tech under pressure clearly. But what's interesting, Adam, it looks like folks are, they're not ducking and running for cover. They're kind of, all right, they're ducking out of tech, but then it feels like they're rotating, right? They're finding new trades, new ideas, new opportunities, a broadening. Is that how you see it or no?
Absolutely. And look, I never like to see red on the screen, but what I do like about the current market is you look at the intraday lows today. We did recover into the close a little bit, but the intraday lows, 70% of the S&P 500 was trading up. And so this is not a case where we're seeing this indiscriminate selling. This is really targeted. This is something that is really confined to technology primarily. We saw semis really sell off today. It was software yesterday. And so this is more targeted selling where people are selling first. They're going to ask questions later. But in the meantime, they're focusing on quality and those other areas that maybe aren't as exciting as AI. And that's okay because boring can still be good in this environment.
It was interesting, Adam. I had Morgan Stanley's Adam Pauker on the show earlier today, and we were having a discussion about valuation and just how he thinks about valuation, how he would characterize valuation. He told me he thinks valuation can actually stay supported around current levels. He told me, valuation actually tends to expand when earnings growth is strong, so above the historical median, and the Fed's accommodative. I'm just wondering, what do you make of those comments? Do you agree, disagree? What do you think?
Yeah, look, I would agree that valuations can remain at these levels. Whether they have much more room to expand, I think that's a question mark. I think that instead we need for earnings to grow into valuations. I think to sustain and justify the current valuations where we are, call it 22, 23 times on a forward PE basis for the S&P 500, we need to deliver on expectations for 14% or so earnings growth in 2026. So I think that's going to be really critical. We've been talking a lot about what could go wrong and what can go right. That's what's going to drive the market here. And so that really explains why we are neutral. We think that we can certainly point to upside catalysts for the S&P 500 and for the broader markets, but we can also point to a number of risks as well.
We just heard from Alphabet. Looks like the stock edging lower here, down about 2% in the after hours. We'll have Amazon on deck tomorrow. You're underweight the Mag 7. How come? What are the key risks there? Is that earnings growth, Adam? Is that valuation? What do you see?
Yeah, it's both, certainly. And we've been underweight for several months now. And we've been telling our clients, look, you can express your belief or optimism around the AI trade. It doesn't mean you have to own the index weight. And I think that's really important that we could be deliberate in our positioning. We're not, we don't have a mutual fund where we have to really focus too much on tracking here. I think it's important to pick and choose your spots. And so as we focus on the Magnificent Seven, we're looking at a group where we've seen operating margins expand by double digits, by about 10% over the last 3 years. You have to ask yourself how much further that can go as we start to see people start to question all the investment going into this, and we see new competition. We see these companies starting to leapfrog each other. And so that's one of the reasons that we're just focused away from it. We think that they are still profitable, they're still printing cash, but we also want to focus beyond the Mag 7, and we think that that's where the opportunity lies.
You also say here, Adam, you're preparing your clients for more volatility ahead. How do you prepare them? I mean, how do you keep them sort of just focused and disciplined, even if we see drawdowns?
Yeah, it's we really try hard. I think it's really important first to just state the facts. We're coming off 3 very good years for risk assets, focusing on the S&P 500, cumulative returns of close to 80%, back-to-back-to-back years of 15% plus returns. And so I think just stating the facts and the current landscape, we can all acknowledge the geopolitical risks, but let's also just look at the calendar here. It's a midterm election year. Historically, those are more volatile. You see average intra-year drawdowns of close to 19% versus 12% in years 1, 3, and 4. So right there, there's likely to be more volatility here. And I think it's really about hammering it and focusing on that long-term financial plan, which we do for all of our clients, and saying, look, your portfolio, your financial plan is built to withstand short-term periods of volatility. If we do see a little bit of a stumble, that's okay. It's healthy. And as long as our economic outlook remains favorable and earnings continue to deliver, we think that any sell-off will be relatively short-lived.
Adam, great to have you on the show today. Thank you.
Thank you.
Time now for what to watch Thursday, February 5th. It's another big day of earnings. We're going to be hearing from energy giants Shell and ConocoPhillips, as well as Michael Saylor's strategy. But all eyes are on Amazon. The company reporting Q4 results after the markets close on Thursday. Analysts focusing on AWS and expecting cloud growth to reaccelerate on rising AI demand and infrastructure buildouts. Meanwhile, retail is coming off what looks like a strong holiday shopping season. The questions for investors: whether AI is showing up meaningfully in revenue and margins, and how much Amazon plans to spend on CapEx to support that growth. We'll also be getting reports from the healthcare sector, including Bristol Myers, Squibb, and Cigna. For Bristol Myers, analysts are focusing less on the quarter and more on the pipeline. Some fresh commentary from the Fed also coming out on Thursday, this time from Atlanta Fed President Raphael Bostic. Bostic recently weighing in on Trump's Fed chair nominee Kevin Warsh, saying he wishes him the best and that he has a very large job ahead of him replacing current chair Jay Powell. And moving over to housing, we'll be getting new mortgage rate data from Freddie Mac. Current rate on the 30-year fix is sitting at 6.1%, an elevated level for home buyers and keeping affordability issues front and center for the housing market. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. And I've got you covered for the next half hour with the latest and greatest market moving stories. Stay tuned.